Good evening, good evening, good evening. Greetings, and welcome everyone. Welcome. This is Chief Kalinago with another video. Today I'm going to do part 3 of the Forex training, okay? So do me a favor, guys. If you haven't seen part 1 and 2, go back to my previous 2 videos, I think, and you will see part 1 and 2. We are going to do part 3 today. I'm going to give you some time to get on. Let me just make sure I'm good on YouTube. Okay, so I'm good on YouTube. All right, I'm gonna make sure I'm good on Facebook. Let me see if I'm good on Facebook. Give me a second here. While you give you guys some time to log on. All right, boom. Good evening. Great for you today. I'm gonna give you stuff. All right, good. Okay, beautiful. So today I'm gonna do part 3 of the Forex trading. Greetings, Zazie. And but before I do, I want to just share a screen with you. I want to acknowledge the great spirit, universal intelligence, the great I am. I want to give thanks to my ancestors and, of course, my higher self for always guiding me in the right direction. Okay, let me share my screen real quick and get into this, because I just want to bring information to prepare you guys, to see what's coming. So you will never have the excuse to say, well, hey, I didn't know. All right. So I'm gonna be doing that giving you guys that information for those who want to learn. Okay. Now this is from Forbes, online, and it says online learning has shown significant growth over the last decade as the internet and education combine to provide people with the opportunity to take or to gain new skills. Since the Rona outbreak, online learning has become more centric in people's lives. The pandemic has forced schools, universities, and companies to remote working, and this booms the usage of online learning. Even before the pandemic, research and markets forecast the online education market as 350 billion by 2025. So the numbers might be updated after analyzing the growth impacts of the Rona on online learning market. So as you can see, even before this so-called pandemic, yes, I said it, pandemic, the online learning, it was already heading towards that curve anyway. And it's an industry of $350 billion. It was estimated by 2025. So since the pandemic, just realize what took place. You see, everything is strategically done. You see, a lot of you don't realize that. Everything was done intentionally, because why? We are moving into an age of an information age, a digital age. And family, I don't want you to be left out. I really don't want you to be left out. And that's what a lot of you don't realize, okay? It is being done that way because AI, artificial intelligence, have to try to keep up with the real true intelligence. So let me ask you a question. Why would I have a brick and mortar building where I'm paying millions of dollars for every single year to have a school when I could do it online and practically just do what? Pay for the price of the internet and at the same time make the same amount of money. You see, y'all don't realize what's going on. You really think it's because the pandemic and, oh, well, we can't go back into these buildings because we have to wear a mask. No, it's strategically done. Why? Because it just makes sense for business. Man, I'm here all day trying to teach you guys and open up your eyes and show you what's going on. But too many of you are actually in your emotions and you're not seeing it. And a lot of you aren't getting it. So even before the pandemic, it was already estimated that online learning or universities would have gone up to about 350 billion. So now it has been accelerated because of this pandemic. So now we are talking about 500, 600, 700 billion dollars already. So if universities and school, they are a business. So let me ask you a question. Why aren't you getting a piece of this pie? Why aren't you getting a piece of the pie, family? Man, I tell you, man, I wish I could have if I could just find 1,000 people with my mindset, man, I'm telling you. In fact, not even 1,000. Just give me 100 people with my mindset. We will change the world. I'm telling you. Because 99.5% or 99.9% of the masses, they are gone. And I know I cannot be the only one seeing this and doing something about it. Because even if a lot of people see it, they're still not doing anything. They go about the regular average day, go to work like nobody cares, like the job is going to last for the rest of their lives. Family, you gotta get ahead of the game. Okay, you gotta get ahead of the game. Oh, no doubt. When the student is ready, the teacher will always appear. All right. But now it's about the information. The information is here. Okay. So with that being said, let us get into part 3 of the Forex trading lesson that I've been teaching. All right. Let me go here and let me go to my, give me a second. You may want to get a pen and a pad to take some notes, or you could just go back over the video again. I already did part 1 and I did part 2, and this is part 3. Okay. So here we are. So by now, based on my videos, you should already know what Forex is. Okay. You should already know about quote currencies and base currencies. You should know what the pip is. You should know what the margin is. You should know what leverage is. You should already know all that. You should know what the analysis means, whether it's fundamental or technical analysis. You should already know that stuff. You should know what bullish means. You should know what bearish means. You should know what going long is and going short is. You should know all that stuff already because we spoke about it. You should know a little bit about brokers, okay? And how they break down the leverage. So you should know that already. And you should already know how to calculate the pips. We already went through that, I think, in lesson 2. But those videos are actually on there. So today we're going to continue day 5, lesson 1, Forex trading basics. How to short Forex, short selling currency explained. All right. Now, short selling currency involves taking positions under the pretense of a bearish sentiment. Remember, when the market is bearish, it means that it's going down. You're taking a short. All right. It's going down. Historically, short selling has been used in the commodity market under negotiated contracts. However, in the current financial markets, short selling has spread to almost every financial instrument, with the most prevalent occurring in the Forex market. Short selling is used by traders to hedge currency exposure or simply to profit from forecasted analysis. Okay, so you will also know in the past lessons that I just did, the past 2 lessons, you'll know the difference between the vast difference between the Forex market and the stock market. The stock market cannot compare, period, because it only trades about 257 billion a day, whereas the Forex market trades close to about 7 trillion a day. So you tell me, which one would you rather trade in? The one where you could literally go in and trade and pull out money from 7 trillion or 257 billion. I mean, again, it's like trying to compare not even apples and oranges, right? I'm just saying, it is just so different, right? Now, in this lesson, we'll explore the basics of short selling Forex using the Euro USD currency pair as example to explain the steps involved. We'll continue to emphasize on suitable risk management throughout the trade journey. Now, as a trader, of course, you will also learn the different styles of trading. Okay, the key to being a successful trader is risk management, learning how to manage your risk. That is key. All right, discipline. What does short selling currencies involve? The term short selling often confuses many new traders. After all, how can we sell something if we don't own it? This is a relationship that began in the stock market because Forex was even before Forex was even thought of. All right. Traders that wanted to speculate on the price of a stock going down created a fascinating mechanism by which they could do so. Traders wanted to speculate on price moving down may not own the stock they want to bet against, but likely somebody else does. Brokers began to see this potential opportunity in matching up their clients that held the stock with other clients that wanted to sell it without owning it. The traders holding the stock long, remember when you're buying, that's the buy position, you're going long, can be doing so for any number of reasons. Perhaps they have low purchasing price and do not want to enact a capital gains. So with that being said, and we explained that in lesson 1 or 2, you may ask yourself, well, Chief, if the market is trading $7 trillion a day, where is this money at? Well, the money is not held anywhere per se. You don't own the currency. All you're doing is just selling and buying. Okay, so it's all done digitally. It's all done. It's like, it's amazing. That's all I could say. Like you're buying one currency, and instead of having it in your hand, you have it virtually, but at the same time, you're selling another. So you're selling another when the price goes down so that you will have an opportunity to buy low again and sell high. And that is the basic fundamental of being a skillful trader. Okay, of course, coupling that with risk management and learning how to read the charts. All right. Now, in the Forex market, transactions are handled differently to stocks, which means the process of short selling a currency pair is very different. Firstly, a currency pair involves a base currency and a quote currency as seen in the image below. And we went over that. You should be able now to identify what the quote is and what the base currencies are. All right. Each currency quote is provided as a two-sided transaction. When you short sell a currency pair, you are effectively selling the base currency and buying the quote currency in expectation that the value of that currency pair will fall, just like how I just explained. All right. So here's an example. All right. And of course, you should know by now what a pip is. All right. So you have this pair right here, the GBP, and each currency pair or each currency is abbreviated by 3 letters. So the GBP stands for the Great British Pound, and of course the Euro currency is the EUR. Now you have the base currency, which is the first currency in the pair, and then you have the quote currency, which is the second currency in the pair. And the pip is the fourth decimal point, okay, in that currency pair. All right, and then to know the spread, meaning that that's how the brokers get paid. You know, you would see how you calculate that 1 pip. All right, if that makes sense. Now, how to short Forex, Euro versus USD short selling example. Taking a short position in Forex involves understanding or understanding currency pairs, trading system functionality, and risk management. You will always hear us stressing risk management, okay? Now, taking a short position in Forex involves understanding or understanding pairs, trading system functionality, and risk management. First, each currency quote is provided as a two-sided transaction. This means that if you are selling the Euro/USD currency pair, you are not only selling euros, but you are buying the dollars. Okay, so in this example, you are selling euros and at the same time buying dollars. So you are selling the euros, okay, because the price is going down, hoping you could buy it at a later date and then sell it back again. You see, that is the amazing beauty about the Forex market. All right. Now, because of this, no borrowing needs to take place to enable the short sale. As a matter of fact, quotes are provided in a very easy to read format that makes short selling more simplistic. All right. Want to sell the Euro USD? Easy. Just click on the side of the quote that says sell after you have sold to close the position. So what we do is in our program, our online program, we teach you the very basics. You don't have to be a professional to learn how to trade effectively and profitably. Why? Because while you are learning, we are teaching you how to earn, because we have 6-7 figure earners, okay, that's going to teach you how to take trade alerts while you are learning. And at the same time, we're going to teach you how to build a home-based business that could build residual income. And now you see why poor people stay poor, because they have missed this. It wasn't taught to the masses. Now I'm bringing the information to you, and I'm certainly sure I'm not the only one, okay, But we have an amazing program and we have an economic wealth building team. I'm telling you, it is totally, seriously off the chain, and we are making a difference in people's lives financially. Okay. So therefore, after you have sold to close the position, you want to buy the same amount. If you end up buying at a lower price than where it was sold, you would end up with a profit. Excluding commission and fees, most likely just, the broker commissions, which they get what they call the spread. That's how they get their money. All right. Now, you could also choose to close a partial portion of your trade. What that means, we are going to teach you a technique where when you are doing your trades, right? Once you have executed your trade, we also show you how to take your profit. So you could partially take parts of your profit, even if you have a long or a short trade. All right. Once you hit your target, and literally, because what you're going to do is you're going to learn how to set up support and resistance. You're going to learn how to use trend lines. Okay, so once you have set that up and you find that zone where you enter the trade, once it hits your target and you get profit, then you could move what we call your stop loss, so that you could take some of your profits even before the trade closes. Family, it's amazing. Okay, for example, let's assume we initiated a short position for 100,000 units, of course, and sold Euro USD when the price was at 1.29. If the price has moved lower, the trader could realize a profit on the trade, excluding commissions and fees. But let's assume for a moment that our trader expected further declines and did not want to close the entire position. Rather, they wanted to close half of the position to cover the initial cost while still retaining the ability to stay in the trade, just like I mentioned. Okay, so you could move the position of your trade, all right, to either break even. So now the trade, there is no risk in the trade, or you could move it further up. It depends on whether you're doing take profit 1, take profit 2. You could move your trades so that you always stay in profit. And of course, with our courses, or our classes rather, you will be able to learn and do all of that. It's a portable skill that you could take anywhere in the world with you and learn to take your cell phone and turn it into an ATM. Now, if the price has moved lower, the trader could realize the profit. Oh, I just read that already. Now, the trader that is short $100,000 Euro USD can then manually enter in 0.5, then click on the close button to begin the trade closing process of 50K, offsetting half of the 100K short position that was previously held. All right, so there you go. All right, just like what I mentioned. Okay, you could literally move your stop loss so that you're able to at least secure half of the trade. All right, and all that stuff you'll learn in detail in our program. Okay, our trader at that point would have realized the price difference on half of the trade, 50,000, was from 1.29 entry price to the lower price they were able to close on. The remainder of the trade would continue in the market until the trader decided to buy another 50K in Euro USD to offset the rest of the position. And even while you're in a trade, even if you move your stop loss and you could literally look at the market and find another zone and step in to take another trade in that same trade. Okay, I'm telling y'all, man, it's amazing. Sometimes within one trade, you could literally get at least 3, 4, 5 entries. Amazing. How to manage the risk of short selling currencies. Short selling Forex carries high risk as there is no maximum loss on a trade. Losses are all unlimited, as Forex values can theoretically increase to infinity. On a long or buy trade, the value of a currency can never fall below 0, which provides a maximum loss level. Managing risk on accounts was a trait we discovered that with successful traders. Fortunately, there are ways to mitigate this short selling risk. Number 1, ways of managing your what we call risk to reward, right? You have implement stop losses, which I just spoke of. You have monitor key levels of support and resistance for entry exit strategies. Okay. Stay up to date with the latest economic news and events for potential downside risk. And that's what we talk about, the fundamental analysis, right? And then we have employ price alerts on trades is a good way to stay informed when you are away from your platform. So what we're also going to teach you is, even if you're away from your phone, you could set up alerts on your phone to know exactly what's happening in the market so that you will not miss a trade, or, you know, pretty much lose more money than you would have wanted to. Okay. Price alerts are mobile / email notifications that update traders when certain price levels are reached on a specific market. These price alerts can be predetermined to suit the trader's key levels. Short selling Forex is preferred for down trading markets. However, careful consideration is required before trading, as it brings extra risk with even with a bearish outlook. It has been utilized by large institution traders as hedges, or by traders looking to trade descending markets. Risk management is essential for the proper application, and the method mentioned in the lesson should be given the utmost consideration, as adverse movements in price can be detrimental. All right, because the market moves really fast. So that's why risk management is key. Day 5, lesson 2. What does a forex spread tell traders? Forex spreads explained. Main talking points. Number 1, spreads are based on the buy and sell price of the pair currency. Number 2, costs are based on forex spreads and lot sizes. Number 3, forex spreads are variable and should be referenced from your trading platform. Okay, so again, the spreads is determined on the type of broker that you have. And we also spoke about lot sizes as well. Okay, Tim asked a question. Do they accept negotiable instruments such as promissory notes to start? Well, family, you could use the US dollar to start. Okay, it's $1 to me. So you could go ahead in the market and trade with dollars, and you could also trade with Bitcoins or cryptocurrencies. All right, just so you know. All right, but they use the US dollar. Okay. All right, so here we go. It's important for traders to be familiar with FX, which is Forex spreads, as they are the primary cost of trading currencies. In this lesson, we explore how Forex spreads work and how to calculate costs and keep an eye on changes in the spread to maximize your trading success. You're absolutely welcome, Brother Tim. What is a spread in Forex trading? Every market has a spread, and so does Forex. A spread is simply defined as the price difference between where a trader may purchase or sell an underlying asset. Traders that are familiar with the equities will synonymously call this the bid-ask price. All right. Below, we can see an example of the Forex spread being calculated for the Euro USD. First, we will find the buy price at 1.13398. and then subtract the sell price of 1.3404. What we are left with after this process is a reading of 0.00006. Traders should remember that the pip value, remember the pip value is the 4th decimal place, okay, is then identified on the Euro USD as the 4th digit after the decimal point, making the final spread calculated as 0.6 pips. So that's how you calculate the pips or the spread. All right. And it's really, really simple. It is not complicated. Once everything is repetition, it may be new, it may seem intimidating, but guess what? I didn't know none of that stuff in this context 4 months ago. But yet still I was already trading currencies for 2 years, but I didn't know about the technical aspect of it. At least I knew that much. I was able to realize that to make money, I had to buy low and sell high. That's just a basic thing that we grew up with. Okay, it's really that simple. When I was younger, that's what I used to do. I used to buy candy, okay, at the store, wholesale, and then go to school and sell it. Buy it for 5 cents and sell it for 25 cents. So I mean, that's stuff we grew up with. pretty much. So it's the same thing you are doing in the market. So I knew that much. But because of our courses, all right, in our university, it's given me the skill now to be able to go into the market, read the charts, and become a skillful trader. All right. Is there Mr. Hastings? It's a university, and all universities, of course, there's tuition. So by all means, my number and my email is on the is there. So please send me an email or a text, and I'll make sure that you come to one of our classes and see what the information is about. If you find value, then I'll show you how to get started. But that's a great question. Absolutely. Okay. So please reach out to me. And thanks for the question. Now we know how to calculate the spread in pips. Let's look at the actual cost incurred by traders. How to calculate the forex spread and cost. Before we calculate the cost of a spread, remember that the spread is just the ask price less or minus the bid price of a currency pair. You're absolutely welcome, Mr. Team. All right. So in our example above, 1.13404 minus or less 1.13398 equals 0.00006. Now, of course, let's go back to, when we were children, right? You know that if you have a decimal and you have 0 zeros after the decimal point, right? The zeros after the decimal point has no value. So it could just be 0.6. All right. So you see, who would have thought that would have came in? Something we learned in kindergarten, but the stuff we learn in college will not make us money. I'm telling y'all, this is amazing, right? This is amazing. Using the quotes above, we can currently buy the Euro/USD at 1.1304 and close the transaction at a sell price of 1.13398. Okay, that means as soon as our trade is open, a trader would incur 0 pips of spread. Okay, now to find the total spread cost, we will now need to multiply this value by pip cost while considering the total amount of lots traded. When trading a 10K Euro USD lot, okay, the lot size is, again, the amount that you're trading, you would incur a total cost of 0.00006 or 0.6 times 10,000, which is the lot, and that equals 0.6 and in dollars. Okay, if you were trading a standard lot of 100,000 units of currency, your spread cost would be 0.0006 pips or 0.6 pips times 100,000. That would be one standard lot equals $6 opposed to 6 cents. All right. Now, if your account is denominated in another currency like the GBP, the British pound, you would have to convert it to US dollars. So you have 0.6 spread in pips times $1 pip cost per 10K lot, 0.06 spread cost. All right. Understanding a high spread and a low spread. It's important to note that the forex spread can vary over the course of the day, ranging between a high spread and a low spread. This is because the spread can be influenced by multiple factors like volatility or liquidity. Remember, volume creates volatility and liquidity. All right. So you in part 1 and 2, you will learn. We talked about what that meant. All right. You will notice that some currency pairs, like emerging market currency pairs, have a greater spread than major currency pairs. Your major currency pairs trade in a higher volume, which I just mentioned, right? The volumes compared to emerging markets and the higher trade volumes tend to lead to lower spreads under normal conditions. Additionally, it's well known that the liquidity can dry up and spreads can widen in led up to major news events and in between trading sessions. High spread. A high spread means there is a large difference between the bid and the ask price. Emerging market currency pairs generally have a high spread compared to major currency pairs. Okay. A higher than normal spread generally indicates one of two things: high volatility in the market or low liquidity due to out of hours trading. Before news events or during big shock, Brexit, US election, spreads can widen greatly. Again, we are talking about the fundamental analysis of these spreads. Okay, low spreads. A low spread means there is a small difference between the bid and the ask price. It is preferable to trade when spreads are low, like during the major Forex sessions. And we spoke about that in lesson 1 and 2. All right. We're talking about the London market, especially the most volatility and where it's most liquid is when the London market it overlaps with the Asian market. Okay. That's where literally money is just flowing from the sky. Its family is beautiful. All right. Now, a low spread generally indicates that volatility is low and liquidity is high. Keeping an eye on absolutely, no problem, Brother Hastings, no problem. Looking forward to that. Okay. Keeping an eye on changes in the spread. News is a notorious time of market uncertainty. Releases on the economic calendar happen sporadically, and depending if expectations are met or not, can cause prices to fluctuate rapidly. Just like retail traders, large liquidity providers do not know the outcome of news events prior to their release. Because of this, they look to offset some of their risk by widening the spreads. Now, another thing you'll learn in our courses is that we'll definitely teach you about forecast, what that means. All right, take for instance, if you have a job, right? And then you look at the news to hear what it's going to be like outside. Is it going to rain? Okay, is it going to snow? Is it going to be cold? Is it going to be hot? Well, in the same thing in our program, we give you what's called a market forecast. So now you could go to that information and it will tell you, well, the market is going to be that. It's going to be such. It's going to be such. Even tell you days, hey, don't trade because certain things are happening around the world. So family, I just cannot stress how amazing our program is, okay? Spreads can cause margin calls, and we spoke about margin calls as well. If you're currently holding a position and the spread widens dramatically, you may be stopped out of your position or receive a margin call. The only way to protect yourself during times of widening spreads is to limit the amount of leverage used in your account, all right? It is also sometimes beneficial to hold onto a trade during times of spread widening until the spread has narrowed. All right. Now, if there's a margin call, meaning that, you know, you have trades and for whatever reason, it could be because the trades, the spreads are widening. What the broker will do is pull you out of the trade. Okay. Pull you out of the trade. So that, or you could make sure you have enough money in there to cover so that you don't get close to that margin call. So there's a lot of ways that you could avoid that, and we also teach you that as well. All right. Day 6, lesson 1, Forex spreads trading strategies and tips. In this lesson, we'll explore top Forex spread trading techniques and key tips traders should follow to protect themselves against a widening spread. The Forex spread is the difference in price between the bid, buy, and the ask, sell price. The spread can widen and narrow depending on a variety of reasons, which we get into shortly. Beware of a widening spread. Traders should always be aware of the spread because it is the primary cost involved in Forex trading. A wider spread will lead to a larger trading cost. Times of volatility or liquid currency pairs accompanied with leverage could signal the end of a Forex trader. Keep in mind that the more leverage used in, the higher the spread cost will be compared to your account's equity. So it is beneficial to use little or no leverage, okay? And even if you do use leverage, then again, we teach you how to use risk management. Now, beginner traders should be especially wary of the spread. If you have a small account in size and you take a slightly large position relative to your account size, the spread could widen and you may receive a margin call, or position could even be closed. What does that mean? It means that, you know, you hear me talking about these big numbers. I mean, you don't have to have $10,000 or $100,000 to start trading. Literally, you could start with, you know, sometimes 100, sometimes 250. It depends on the broker. And you could start small, work your way up. To me, in my opinion, and that's just my opinion, I'm not giving financial advice, is better than leaving your money in the bank and not growing at all when they're taking your money and put it in the forex market and make millions. Okay? So I don't leave my money in the bank, period. But that's just me. All right. The following 3 spread trading techniques and strategies are a great way to learn the basics to ensure your FX trading is a success. Keeping an eye on factors that influence the spread, the liquidity of the currency pair, and the time of the day. 1. Keep an eye on factors which affect the size of the spread. To avoid large spread costs associated with a widening spread, traders should be aware of the following factors. Number 1, volatility. You already know what that means, but let's go over it again. Volatility in the market by economic data releases. We're talking about the fundamental analysis, or a breaking news event could trigger a spread to widen. Liquidity. A lack of liquidity in the market could also cause a spread to widen, meaning that not a whole lot of people are actually in the market. So when that happens, it allows the spreads to get a little wider. Okay, liquidity and volatility are 2 interconnected concepts. Illiquid currency pairs, such as emerging currency countries, are known for their high spreads. Illiquid markets can also be a cause of volatility. So that what that means is a lot of emerging countries, when you're trading your currencies, since there's not a lot of liquidity and or volatility, those spreads widen. Why? Because it's not a lot of people. There's not a lot of volume of people that's trading those currencies, so it widened the margin. Okay, in layman's terms, that's what they are saying. Now, spreads and the news. Before a popular news event like the NPF employment number release, liquidity providers may widen their spreads to offset some of the risk caused by the event. Usually the spread will revert to its mean after a few minutes. So it is advisable for traders to be patient and only trade when the spread narrows. Okay, and those are some of the things that we're going to teach you in our forecast. We'll let you know when there are events that you should look out for, days you should just stay out of the market. You see what I'm saying? But of course, you could do what you want, but we will guide you accordingly and appropriately. Okay. Number 2, choose high liquidity forex pairs. Another forex spread trading strategy many traders, particularly beginners, adopt is choosing high liquidity forex pairs. Under normal circumstances, high liquidity pairs have lower spreads. What does that mean? It means the most popular. They have 8 major currency pairs. So what we teach our scholars, which we call our students, is that we advise them to master at least just 1 to 3 of the major currency pairs and master those before you move on. So we have your major currency pairs: the Euro USD, all right, Euro, the Euro dollars, the Euro USD, Euro versus the dollar. Then you have the US JPY, which is the USD, the United States dollar versus the Japanese yen. Then you have the GBP versus the US dollar, which is the British pound. Then you have the USD versus the CHF, which is the Swiss francs. Okay, they have nicknames such as Sweezy, okay, for the franc, where we'll have the lowest spread amongst all currency pairs because they trade in high volumes. So because of the high volume, we have high liquidity and volatility, and those create what we call tighter spreads or lower spreads. All right, these currencies do not always trade at low spreads, and because they are affected by volatility, liquidity, and the news, which can lead to widening spreads. So that's where the forecast comes in. Now we have the emerging countries. Okay, emerging countries like USD, MGN, which is the Mexican peso. Then you have the USD versus the ZAR, which is the South African rand, or the USD versus the ruble, which is the Russian ruble, generally have higher spreads compared to your major currency pairs. Therefore, it is wise for traders to trade these pairs with less leverage, because the more leverage you have, the more you put your account at risk when the spread is wide. Okay, and all those things we are going to teach you in more depth. All right. In the image below, the black boxes show the spread of the certain currencies. the major market currency pairs, USD JPY and the Euro USD, display narrow spreads, 0.7 pips and 0.6 pips respectively. The emerging market currency USD versus the ZAR, and the ZAR is the South African Rand, and the USD, the Rub is the Russian ruble, on the other hand, have extremely wide spreads of 90 pips and 1,000 pips respectively. So in that case, you want to have less leverage on that to avoid, okay, blowing out your account. So as you could see, you have the major currency pairs right here. You have the small spreads, all right here. You have the USD versus the JPY. Remember, in the anytime the JPY, meaning that the Japanese yen, is in any currency, know that the pip is going to be the second decimal point. All right, the second decimal point. In any other currency pair, all right, it is the fourth decimal point. So as you can see, the spreads are low, 0.7 and 0.6. Now, emerging countries, you could see right here, they have bigger spreads, 90 pips and 1,000 pips. Okay. Number 3, time of the day, that impacts the spreads as well. The time of the day influences Forex spreads. So it can be useful factoring this in your strategy. During your major market trading sessions, you have the London, the New York, the Sydney, and the Tokyo. Forex spreads are normally at their lowest due to what? High volume being traded. So we spoke about that, right? I told you about the London market, the New York market, the Sydney, and the Tokyo, which is all considered to be part of the Asian market, so to speak, right? And then where the Asian market and the the London market, pardon me, and the New York market overlaps is the London market, not the Asian, all right? The London market and the New York market overlaps, I think, between 8 a.m. Eastern and I think 12 p.m. Eastern or 5 p.m. Eastern. That's where it is most liquid and volatile, all right? But those times right there in those sessions, you will get the low spreads. Forex traders could trade during these times to take advantage of narrow spreads. When the London and the New York session overlap, spread can become even narrower. So people are making a killing when the London market overlaps the New York market. So family, you could use your cell phone, I'm telling you, and turn that into an ATM once you learn this skill. I'm telling you, this is the wave of the future. Nobody's going back to a brick and mortar building to pay huge tuitions and put yourself in student loans debt. Okay, right now people are begging for the government to give them student loans forgiveness. All right, and I have an article on that and I will share it with you guys. Okay, the hours shown below are Eastern time between 8 a.m. and 11 p.m. Eastern time, the London and the New York. So it's actually 8 and 11. I said 12 or 5, but it's actually 8 a.m. and 11 p.m. Eastern. All right. Forex spreads trading example using the USD JPY, which is the Japanese yen. If you combine all the above spread trading techniques, you can reduce the risk of trading at high spread. It is important to remember these steps when executing a trade and when closing a trade, because the spread may change from when you open the position to when you want to close the position. Let's look at a simple example using the USD JPY, which is among the major currency pairs, meaning it has high liquidity and therefore very low spreads compared to other Forex pairs. Keep an eye on factors that may affect the spread. If we were to trade the USD versus the JPY, we need to make sure that there are no shock events or data releases that would affect the spread. You can do this by keeping up the date with the latest news and using the economic calendar. So also we teach you about that too. We give you websites that you could do your forecast. Okay, we give you websites that you could see the latest news that may affect the currency pair, what's happening in that country at that time. And we also give you an economic calendar where you will actually go into, all right, and literally where you could click on and see what type of temperature that currency pair is going to either have for the day or the entire week. That's part of your forecast, all right? And if you see the folder, if it's kind of like almost yellow, greenish, yellowish, that means that the currency pair is potentially going to be bullish. There's no major news affecting it, all right? Then if it's red, then that means that that currency pair is going to have high spreads because something is happening around the world that's going to affect that currency. And you may not want to trade that one in particular that day. The beauty about it is there are other currency pairs that you can trade. Okay. A sample from the economic calendar is below. Events with a high impact, all right, impact have a higher chance of increasing the spread. So unless you are trading the news events, it is wise to trade around these events. Some events that could increase volatility and the spread include the GDP release, all right, the CPI inflation data, NFP non-farm payroll. So as you can see, when you go to do your forecast, right, when you see a currency pair on the folder, it has high and red, that means stay away from that. Okay. If you see it's like, you know, kind of like medium, then you could trade it. Okay, you could trade it, of course, and then if it's a little closer to more, you know, green, then it's telling you that, man, that's a good time to trade that currency pair. Okay. Consider the time of the day trading. We also need to consider when to trade the USD JPY. The USD JPY has a lot of volatility. One of the most liquid times to trade Forex is between 8 a.m. and 11 a.m. Eastern time. So during that time, I'm telling you, you could get on your phone, get on your computer, your laptop, your iPad, and, you know, literally make some money. Okay. When the London and the New York session overlap, the US JPY also is highly liquid during the Tokyo session. All right. So you could also trade the US JPY is also high during the Tokyo session. Emerging market currencies can see extremely large spreads. They trade out of their main market sessions. When trading emerging market currencies, you should plan to trade them during their main market hours when they are most liquid. All right. So if you are not going to trade the main currency pairs, you could trade the upcoming currency pairs, which is another name they call exotics. Okay. Well, what you could do as well is make sure you trade them when they have high volume or liquidity to get tighter spreads. Okay. All right. So we have day 7, lesson 1. Many people are attracted to Forex trading due to the amount of leverage that brokers provide. Leverage allows traders to gain more exposure in financial markets than what they are required to pay for. Okay. Traders of all levels should have a solid grasp on what Forex leverage is and how to use it responsibly. In this lesson, we'll explain Forex leverage in depth, including how it differs from leverage in the stocks and the importance of risk management. So this is what leverage is really. Okay. You have a margin deposit. Okay. And then you have the full size trade. So in other words, you come in with a low margin or a deposit, and the broker is going to give you the opportunity to trade a larger size of money. And we give an example of leverage when you went to buy a house. If you were to buy a house and you went to the bank, if the house is 200,000 or 400,000, you may not have that full size amount. But the bank is saying, hey, give us a deposit, a margin of 30%, 40%, and we'll make sure you get the house. So that's what leverage, an example of leverage in the Forex market. What is leverage in Forex trading? Leverage in Forex is a useful financial tool that allows traders to increase their market exposure beyond the initial investment deposit or margin. This means a trader can enter a position for $10,000 worth of currency and only need 1,000 in a 10-to-1 leverage scenario. So that's considered a 10-to-1, where if, let's just say, you have $1,000, all right, then the broker will allow you in a 10-to-1 leverage scenario to trade up to 10,000. So family, you see the potential of how much money you could make. You only have to put $1,000 in your account, in your trading account. Now, it could be less than that. You could start with 100 with some brokers. But the point is, you could start with 1,000 in your brokerage account, and from a 10-to-1 leverage, you will be able to trade $10,000. Okay. If the leverage is 50-to-1 and you have $1,000, it will be $1,000 times that amount, which is I think 50. So that would give you, I think, like probably what, 50,000, something like that. Okay, so the point I'm making is leverage is good and leverage could be bad if you don't practice what we call risk management. All right. Now, however, it's essential to know that gains and losses are magnified with the use of leverage. All right. So, and that's why I said it's a double-edged sword. You could make a lot of money and you could lose money faster that way as well. All right. In adverse market scenarios, a trader uses leverage might even lose more money than they have as a deposit. Leverage of 10 to 1 means that traders can gain exposure to a notional value or trade size 10 times more than the deposit slash margin that is required to fund the trade. This can be thought of in a similar fashion to putting a 10% deposit down on a house, which we explained. You gain access to the entire house while only funding 10% of the full value. Okay. Leverage is usually expressed as a ratio. So leverage expressed in words. You have the 10 to 1. Leverage expressed, so it's 10 to 1, right? Then you have 30 to 1. 30 to 1. Then you have 50 to 1. Here you go. All right. Expressed in ratio. The amount of Forex leverage available to traders is usually made available through your broker, and the amount of leverage will vary according to the regulatory standards that preside in different regions. So based on the region, then you may or may not, especially with regulated brokers, I think for the US is 50 to 1. But if you have an unregulated broker, you have a chance of getting higher leverages as well. Okay. Now, leverage in Forex versus leverage in shares. Forex leverage differs from the amount of leverage that is offered when trading shares. This is due to the fact that the major Forex pairs are liquid and typically exhibit less volatility than even the most frequently traded shares. As a result, hedging risk and getting in and out of a trade or trades is more manageable, okay, in the 6.6 trillion or reaches right now about $7 trillion a day Forex market. How is Forex leverage calculated? Traders require the following to calculate the leverage: the notional value of the trade, which is the trade size, okay? Then the margin percentage. So the trade size, which is the amount of what the broker is saying you could trade, and the margin is your deposit, okay? Putting that in layman's terms. Now, brokers often provide traders with a margin percentage to calculate the minimum equity needed to fund the trade, which is the margin. Margin and deposit can be used interchangeably. Once you have the margin percentage, simply multiply this with the trade size to find the amount of equity needed to place the trade. Then this is the equity equals margin percentage times the trade size. To calculate the leverage, simply divide the trade size by the required equity. So leverage would be the trade size, okay, divided by equity. Forex example below is a typical example of how to calculate leverage using the above formulas. All right, for example, the trade size is 10,000 units of currency, right? One mini contract on USD JPY. The mini contract, see, that's the size, the lot size, right? With a trade size equal to 10,000. Margin is 10%. All right, let's calculate that. What is the equity? The equity equals the margin percentage times the trade size. So remember, we were talking about lot sizes. So it's 0.1 times 10,000 equals 1,000. Leverage equals trade size equity, divided by equity. So it's 10,000 divided by 1,000 equal 10 times or 10 to 1. And that's how it's calculated. Okay. We also have a calculator where you're able to calculate that yourself. So again, all this may seem unfamiliar right now, but once you start going through our university, we have information that will make that, which will simplify the equation and let you get used to it, so you are not intimidated. Okay. The example highlights the basic of how Forex leverage is used when entering a trade. However, it must be noted that traders should not simply calculate the minimum amount needed to enter a trade and then fund the account with the exact amount. Traders must be mindful of margin calls. If the position moves in the opposite direction, bringing the account equity below an acceptable level determined by the broker, trading Forex with leverage has the potential to produce large losses as well. So you want to be able to have a little more in your account all right? So that just in case, to avoid the margin calls, which we broke that down earlier, okay? How to manage Forex leverage risk. The key factor in trading is learning how to manage your risk. Leverage can be described as a two-edged sword, like I said earlier, providing both positive and negative outcomes, the yin and the yang, all right, for Forex traders. This is why it's essential to determine the appropriate effective leverage and incorporate sound risk management. And I've been talking about that from the very beginning of the lecture, all right? Top traders make use of stops. Remember I talked about, your stop losses to limit their downside risk when trading Forex. I would recommend risking no more than 1% of your account equity on any single trade and no more than 5% of the equity for all open trades at any point in time. So in our program, we teach at least from 1 to 3% or 1 to 5%, but it is always advisable 1 to 3%. Okay. Furthermore, successful traders make sure of a positive risk to reward ratio in an attempt to achieve higher probability trades over the time. It is vital to avoid these mistakes with leverage. Risk to reward ratio just basically means this. We teach you a system in our university, right? Let's just say you take 10 trades. Even if you were to lose 5 trades and won only 5, we still show you how to grow your account by 10%. Okay? We still show you how to grow your account by 10%. Why? Because we have the style of trades that we use, plus we have professional traders that give you trade signals to help you make money while you are learning. So that's basically what risk to reward ratio means. Okay, let's just say, you know what? I'm going to risk $1, but the reward would be, the potential reward be, if I invest that $1 or I risk that $1, I will be able to get $3. You see what I'm saying? So we're going to teach you that as well. Now let's do day 7, lesson 2. Using margin in Forex trading. How long we've been on here for now? Let me see. All right, let's go for a little longer, then we'll just close this off. Using margin in the Forex trading. Using margin in Forex trading is a new concept for many traders and one that is often misunderstood. To put simply, margin is the minimum amount of money required to place a leverage trade and can be a useful risk management tool. So like I said before, we spoke about margin, where you would not have to put the full amount of the house, but just put a deposit. That's considered the margin, right? In order to gain access to the house, which has the full value. Closely linked to margin is the concept of margin call, which traders go to great lengths to avoid. Not knowing what margin is can turn out to be extremely costly, which is why it is essential for Forex traders to have a so-called grasp of margin before placing a trade. In this lesson, we'll learn more about using margin in Forex trading, how to calculate it, and how to effectively manage your risk. All right, what is Forex margin? Forex margin is a good faith deposit that a trader puts up as collateral to initiate a trade. Essentially, it is the minimum amount that a trader needs in the trading account to open a new position. This is usually communicated as a percentage of the notional or the trade size, all right, of the Forex trade. The difference between the deposit and the full value of the trade is borrowed from the broker, okay? So in other words, again, if you put up 10,000, all right, and 100,000 trade the broker, you put up 10,000, the broker will put the other 90,000 where you're able to now trade 100,000. You see what I'm saying? Now, the difference between, we said that already. FX, which is Forex trade, Forex margin example. Below is a visual representation of the Forex margin requirement relative to the full trade size. So here we are. Margin requirement 3.3%. Different brokers, they have different margin requirements, right? So visual representation of margin, you have $10,000, okay? And then we know that it's 3.3%, okay? So that's $333 is the margin that would be required, right? The connection between margin and leverage. Before continuing, it is important to understand the concept of leverage. Leverage and margin are closely related because the more margin that is required, the less leverage traders will be able to use. This is because the trader will have to fund more of the trade with his or her own money, and therefore is able to borrow less from the broker. Leverage has the potential to produce large profits and large losses, which is why it is crucial that traders use leverage responsibly. Take note that leverage can vary between brokers and will differ across different jurisdictions in line with regulatory requirements. Typical margin requirements and corresponding leverage are produced below. All right. So we have margin required 50%, maximum leverage 2 to 1. All right. 3.3%, maximum leverage 30 to 1. Margin requirement 2%, 50 to 1. Margin 0.5%, 200 to 1. Okay. And again, it depends on the broker. Understanding or understanding Forex margin requirements. Forex margin requirements are set out by the brokers and are based on the level of risk they are willing to assume default risk whilst adhering to regulatory restrictions. So the broker is saying, well, you know what? I'm going to take the risk for you. You put a deposit of such and such, then I'm going to put the difference to take a risk. So let's see if we could make some money together. Basically, that's what's happening. Okay. Below is an example of the Forex margin requirement for the GBP USD under heading deposit factor. Here we are, margin requirements. Margins are calculated according to the tiered margin factors based on the size of your aggregate position. You have the tier, you have the position size, and you have the percentage deposit factor. Okay. More often than not, margin is seen as a fee a trader must pay. However, it is not a transaction cost, but rather a position of the account equity that is set aside and allocated as a margin deposit. When trading with Forex margin, it is important to remember that the amount of margin needed to open a position will ultimately be determined by the trade size. As trade size increases, traders will move to the next tier where the margin requirement in monetary terms will increase as well. Margin requirements can be temporarily increased during periods of high volatility or in the lead to economic data releases that are likely to contribute to greater than usual volatility. The first two tiers maintain the same margin requirement at 3.333%, but then escalate to 4% and 15% in the following two tiers. After understanding or understanding margin requirement, traders need to ensure that the trading account is sufficiently funded to avoid margin call. One easy way for traders to keep track of their trade account status is through the Forex margin level. Forex margin level equals equity divided by margin use times 100. Suppose a trader has deposited 10,000 in the account and currently has 8,000 used as margin. The Forex margin level will be 125 and is above a level of 100 level. If the Forex margin level dips below 100, the broker generally prohibits the opening of new trades and may place you on margin call because they don't want you to over leverage your account. That is just to protect you. Okay, it is essential that the traders understand or understand the margin closeout rule specified by the broker in order to avoid the liquidation of current positions. When an account is placed on margin call, the account will need to be funded immediately to avoid the liquidation of current open positions. Brokers do this in order to bring the account equity back up to acceptable levels. All right, we're going to do just that, and then we'll continue another time. Now, Forex margin terms, we have equity. Equity is the balance of trading account after adding current profits and subtracting current losses from the cash balance. Margin requirement is the amount of money deposit required to place a leverage position. Used margin, a portion of the account equity that is set aside to keep existing trades on the account. And free margin, the equity in the account after subtracting margin used. Margin call. This happened when a trader's account equity drops below the acceptable level prescribed by the broker, which triggers the immediate liquidation of open positions to bring equity back to the acceptable level. All right. So like I said, the broker will pull you out of a trade if you there to avoid margin calls. Okay. Forex margin level. This provides a measure of how well the trading account is funded by dividing equity by the used margin and multiplying the answer by 100. Leverage. Leverage is in Forex is a useful financial tool that allows traders to increase their market exposure beyond the initial investment by funding a small amount of the trade and borrowing the rest from the broker. Traders should know that leverage can result in large profits and large losses. What is a free margin Forex? Free margin refers to the equity in the trader's account that is not tied up in margin for current open positions. Another way of thinking about this is that it is the amount of cash in the account that traders are able to use to fund new positions. All right. This can be explained with an example. Equity is 10,000. Margin allocated to existing position is 8,000. Free margin equals equity minus margin on open position. So therefore, free margin would equal 10,000 minus 8,000. So therefore, the free margin would equal 2,000, right? Very simple. Now, managing risk of margin trading. When trading on a margined account, it is crucial for traders to understand or understand how to calculate the amount of margin required per position if this is not provided on the deal ticket automatically. Be aware of the relationship between margin and leverage and how an increase in the margin required lessens the amount of leverage available to traders. Monitor important news releases with the use of the economic calendar should you wish to avoid trading during such volatile periods. It is considered prudent to have a large amount of your account equity as free margin. This assists traders when affording margin calls and ensures that the account is sufficiently funded in order to get into high probability trades as soon as they appear. So essentially, just have enough money in your account to avoid those margins. Okay. So what we're going to do, we're going to stop here right now. I hope you guys found some value in this. All right, we'll do this was part 3. We'll do part 4. Okay. And so this is like 37. I put this together. So this is about 37 pages of 35. So we got a few more pages to go. However, I will do part 8, day 8, lesson 1 another time, which is going to be part 4. All right. So guys, I want to thank you guys for tuning in to to this build. And let me see. I wanted to show you guys something here. I hope you found value in this, okay? Because I really want you guys to see and realize that, man, this is the wave of the future. We have to learn, something different in order to get something different, because it's really serious out here. All right. And the traditional way that we have learned, okay, it hasn't been working for us. And that's just real talk. All right. Now, let me just show you something that's alarming right now, okay? And this is another reason why I'm so passionate about what I do, because I'm just tired of the fact that people were taught to go to school, okay? Go to school and get all this astronomical, debt. And then when you come off, you can't find a job, man. Something is extremely wrong with that picture. So let me just show you this real quick before we get out of here, okay? So let me go to the Chrome window and So remember back then I told you guys about the Sarah Gissera, where they wanted to implement debt forgiveness for whether it was school, student loans, or mortgages, whatever, right? So they're trying to implement that. As a matter of fact, there are some people already that have already gotten their student loans forgiven. So again, this is not advice. I'm just letting you know the information that's out there. You could call the people that you owe the loan for the student loan and ask them what is the status of your student loan, and then suggest and say, hey, I would like to qualify, or how do I qualify for the student loan forgiveness? All right, or for the debt forgiveness. All right, so they may already have that in place. I don't know, but Some people have already gotten that forgiven. But with that being said, forgiving student loan debt for 10,000 or 50,000, what is the no right now? The average student carries approximately what? $37,000 in debt, and they are looking to help your family. Can you imagine that, right? They teach you how to go to school, get good grades, put yourself in debt to help the business, which is the United States, a corporation, right? And then you cannot find a job to get out of the debt that you are getting into to help the corporation. Now, does that even make sense? And a lot of people won't see this. And that's what's alarming, and that's what's sad at the same time. You would rather put yourself in debt so what you could get a piece of paper to get congratulations, and now you're stressing because you can't pay it back. And that's why I tell people, people will congratulate you for getting into debt. Whether you are buying a house, you are getting married, you're going to school, they would congratulate you for that. All right? But they would shy and run away from me for me trying to show you how to get out of debt and how to become, financially independent. I don't know, man, how people just see things backwardly. I don't know. Maybe something is wrong with me, man. I don't know. Because I have a different mindset. All right. But anyway, Washington is taking multiple paths to help individuals and families through the pandemic from 1,400 checks. Okay. Well, you have to wait an entire year for that. All right. That's why I'm not going to put myself in that position. I don't want nobody's pity. But anyway, I can't tell you what to do. Right. And 300 supplemental unemployment checks to health care savings and the revised child care credit, blah, 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 blah. All right. For student loans, debt in the U.S. is what? Look at this. Loan debt in the U.S. Student loan debt is what? 1.71 trillion, which makes the second consumer debt behind home mortgages. You hear that? I'm not the one saying this. They are telling you. You guys are going to school, all right, and getting debt of about almost $2 trillion. Second behind mortgages. Why do you think people are broke? Why do you think people are crying and struggling? So now they're saying, oh, well, let's give them 10,000 or 50. The point is this. I just wanted to show you that. I'll take that article and put it in the chat, and you could go ahead and read it at your own pace, right? Or in your own time. But I just wanted to show you this right here, to show you how the people was brainwashed into accumulating debt. All right? Accumulating debt. But then do you still think going to school and getting that degree is the answer? Be honest with yourself. Okay? Do you still think, going to a place and getting married and spending 30, 40, 50 grand, do you think that's the answer because you want to prove to people that you love your spouse? Do you think that going into debt and getting a house on a mortgage for 30 years that you may not end up paying, do you think that is the American dream? Y'all have no idea what the American dream is. That's what you were taught. But that's not a dream. That's a nightmare. $1.7 trillion in student loans. I'm showing you guys something different. And the only way to get something different is to do something different. All right? And in this technical age that we're living in right now, this information age that we're living in right now, boom, you could stay home and learn this skill and use your phone and make some money. Period, point blank. And we could show you how to build a residual-based business. Why? Because the government has mandated over 400 tax deductions for home-based businesses. And I keep telling y'all, if you have a job right now, you have a W-2 right now, I can show you how to give yourself a raise. And your job is mandated to give you that because guess what? That's what the government said. But a lot of you, I don't know. It's like I'm begging people to make money. I don't get this. I really don't get this, man. The skepticism is crazy, but yet still, y'all broke. It just doesn't make any sense. It just doesn't make any sense. Like, what have to trigger into your mind to tell yourself, man, what Chief is saying, it just makes so much sense because my great-grandmother went to school, my grandmother went to school, my mother went to school, father, great-grandfather, etc., and they still broke. So what make me think if I do the same thing, I'm gonna come off? I mean, don't y'all realize that by now? Don't you see something is wrong with this picture? And it's not about the color of your skin or who you are. It's about your mindset. Don't you realize that's what's keeping you back? It's your mind, not your skin, not the system. Man, listen, I wish what I was showing y'all right now, somebody had told me that 10 years ago. But you know what? It wasn't meant for me to know it 10 years ago. What matters is now. I'm not going to cry over spilled milk. So any one of you that's in the position right now, okay, and you want to learn this skill, because that's what we have to teach the younger generations. Teach them something different. Send me an email or text me. All right. This is something that it's going to cost you more not to learn it than to learn it. You see what I'm saying? It's going to cost you more not to learn it, period. And the government is telling you, hey, if you have a home-based business, we could show you how to give yourself a raise because it's already yours. Why give it to us? But I keep telling y'all, if you got a job, yo, you got a W-2, reach out to me. Let me show you how to give yourself a raise. And it's like I'm begging people to help them. That just doesn't make sense. And then they want to crucify you. That's why I realize every so-called savior that has come to save the people, people always try to crucify them. Why is that? Why do you crucify the people who want to save you or help save you? And what's going to happen is this, right? Everything is changing right now. And then when you realize that, man, Chief was telling us the truth, guess what? Now you're going to be in a tighter position because you could have taken the opportunity to learn everything right now about trading, learning about cryptocurrencies, learning about building a residual business. Cryptocurrencies is the next thing. It's here. It's going up. So do you think that if you're going to continue to work on your job, making minimum wage, and then cryptocurrencies are more expensive, let me ask you a question. How are you going to survive? Welcome, family. Welcome, Zen. Welcome. How are you going to survive if things are going up, but you're making less? It just doesn't add up. Man. Woo. I tell you. But anyway, I'm about to get out of here, man. All I could do is just bring the information to y'all. By no means this is financial advice. I'm just tired of seeing people struggle, man. I'm just tired of it. All right. Tired of it. And it's funny that you spend your money on things that's not giving you anything in return. I just don't get it. Why am I going to buy an iPhone for $1,400, $800 with a cell phone bill and not being able to make $1 on my phone? That just doesn't make sense. You see what I'm saying? It just doesn't make sense. Yes, you were taught to be consumers, but you got to stop that because consumers get consumed. Man, listen. Woo. I'm telling you, this is just sad sometimes, and it's either sometimes you just want to laugh or you just want to cry, and sometimes the laughter is just to disguise the pain that you feel for people, man. That's just what it is. That's just what it is. Now, let me show you this again because I keep telling y'all consumers get consumed, but for some reason, it's not clicking in your mind. Let me go show you what they're saying again, okay? Let me go show you again what they're saying here because I don't think it's clicking for a lot of people. Let me show it to you again, okay? Look at this and look at the key word. I'm going to read right here, where I'm going to highlight, right here, okay? For students' loan, debt in the United States is $1.71 trillion, which makes it second in what? Consumer debt. They are telling you that you are a consumer. And I've been telling you guys that from day one, consumers get consumed. How many people do you know successfully pay their mortgage? I promise you, you have a 98% chance of losing your home before you pay your mortgage. And that is just the facts of life. I don't know how much more to break it down to y'all, man. I don't know. Oh, I'm not talking about stocks, family. You're going to have to look at the video. I did 3 parts. So this is part 3 right there. So you have some catching up to do. All right. So I'm just showing y'all the reality of what's going on because nobody else is showing it to you. People would rather get on here and tell you about sneakers with blood in them. People would rather get in here and tell you about DMX and his problems. DMX had choices to make. Okay. The people who his parents, they had choices to make. You know, the brother was a good brother, but listen, DMX had his millions going to his family right now. So let me ask you a question. Where's the millions going to your family? So I don't have time for the distractions. I don't have time for that. You guys are always distracted by something in the news, something on Facebook, nothing that's bringing you to a place where you could build wealth. You see what I'm saying? Period. What are you doing that's going to give you residual income? In other words, do it one time and get paid over and over again. But guess what they tell you? Every time somebody tells you something like that, oh, it's a scam, but yet still you got a job, the biggest scam in the world. Woo. Man, I see why people just look for ways to just disguise the pain, man. They have to turn to religion. And that's or weed or liquor because they don't want to face the reality. They don't want to face the reality. But I say this, why not step up and face the reality? All you have to do is change your life, change your mind, and do something different to get something different. It's really that simple. Don't let 2021 go by and you're going to be in the same position doing the same thing and talk about, oh, well, 2022 is going to be my year. Oh, let me make a new resolution. Well, look at the word resolution. Resolution just means resolution. So if you already have the solution, why would you want to do another solution? You see, they got y'all so messed up, you don't even see it. You don't even see it. They're telling you in the words, why would you want to come on December 31st, which number one is not the new year anyway, because it's the dead of winter, but that's another video. And then you make a resolution or a resolution. Why would you want to find another solution if you had it already? Why would you want to fix it if it ain't broken? And then they tell you work for 30, 50 years, and then you could do what? You could retire. Why would I want to work all my life, be tired, and want to do it again? They got you all jacked up, and you don't see the problem. And I keep telling you the same thing over and over again. It's like it's going in one end, it's coming out the next. Because you know what? You still think after 200, 300, 400 years of going through the same thing, it's going to change. Let me just say, okay, you know what? It wasn't 2021, it's going to be 2022. But you've been saying that since 1998. You see what I'm saying? And then you transition and you leave your children and your family in debt. That's the legacy that you're going to live. Or you get old and you lay in your bed, start reminiscing on all the things you should have done. When the truth of the matter is, you could do it now. Anyway, I appreciate love you guys, man. And this is called tough love and passion. It is not here ridiculing people or putting people down. That's not what it means, man. I want to see y'all do better. You deserve better. Okay? Stop begging. Stop being victims. Get up. Stand up. Stop being victims, man. Stop. Stop sitting around and waiting for checks from this corporation. And when they give it to you, they give it to you with a smile because what? They know that you're a consumer. You're going to consume it. Family, what is it going to take? What is it going to take for you to open up your eyes and see the light? What is it going to take? That's what I want to know. Do you want to wait until all of a sudden you walk into a store with a dollar bill and they say we don't use it no more? You need a cryptocurrency? Is that what you're waiting for? Is that what you're waiting for? Hmm? Is that what you're waiting for? That when you can't afford to feed your family, which a lot of people are actually already there? Why do you always have to wait until your back is against the wall to be proactive? Doesn't it make sense to be ahead of the curve instead of being on the curve or on the curb? You see, nobody have to tell me that, because I could see. I don't stay distracted. I don't look at those things that distract people. I don't do that. Why? Because I got free will. So I'm in control of my will. And you have free will as well. But you choose to do the things that will not take you places you need to go. Oh, you see what I'm saying? It take you places you want to go, but not where you need to go. You see, there's a difference in where you want to go and where you need to go. You feel what I'm saying? Because you may want to go to the movies to see the new movie because that's what people are promoting. That's what you want to go see, but that's not what you should need to see. What you need to see is what I'm showing you right now. Okay? That's what you need to see and hear. You may want to go buy the new pair of sneakers, but that's not what that's not what you need to do. What you need to do is invest in yourself and learn that information. See, there's a difference between a want and a need. The universe didn't say, I'm going to provide your wants. The universe said, what? I'm going to provide your needs. But too many of you are focused on your wants and not your needs. That's why you are struggling. Because you always want, and don't know what your needs are. Focus on your needs and the universe will give you your needs. And because of your needs, your wants will be provided. Because you'll be able to afford your wants. You see, you afford your wants, but you deserve your needs. You see what I'm saying? Because that's what the universe said. I will provide all your needs. Because you know why? You deserve it. So the truth of the matter is, you could literally make a decision tonight and say, hey, you know what? Enough with this TV. Enough with this celebrities and what they're talking about. Enough with the media. Enough with this kind of music. Enough with this kind of whatever that's not building me mentally, physically, socially, spiritually, and financially. Let it go. And let me change something today. Right now, I'm going to make that decision to change my life. Right now. Not tomorrow, not next week, not next year, right now. Stop making resolutions and just create the solution so you don't have to look to do it again. So I'm just giving you some jewels, man. That's it. I'm just giving you some jewels. But all I'm just saying is stop being so reactive, meaning that when things already happen, you just want to react. Be responsive. Okay? You know it's coming. So what you do? You start being responsible. That's called, you see, being responsive and responsibility is basically the same word. The ability to respond to your ability. And they always say, if you lie about your ability, you become a liability. Stop being a liability to yourself because you're lying to yourself. Okay? Be real. Stop making people think you got it made because you're fooling yourself as well. Believe me, when I got it made, you will know. I'm telling you. But I'm working right now to make that happen. And I'm not just working hard, I'm working more intelligently. You see, we were just taught to work hard. You feel me? So I'm working intelligently. And like Saki said, a man or a woman, right, with excuses does not exist. And I could put that another way as well. It's either you're making money or excuses, but you cannot make both. You cannot make both. All right. So I'll leave you with this. In the words of Zig Ziglar, actually, is it Zig Ziglar or is it no, Les Brown? Pardon me. I apologize, Mr. Les Brown, for giving somebody a quote. But as you could see, the type of things I listen to motivational speeches and events, and that's what I listen to. I don't get on YouTube and listen to music and then make the da and the heck them bed today. I don't listen to that stuff. Okay. I don't go on Facebook and looking at posts of things of people talking blood and Snickers and the Lumina. I don't do stuff like that. I listen to motivational, inspirational videos. I study how to trade, and I build my residual-based business. Because the only business I need to mind right now is the business that's between my two ears. That's it. My own business. Period. So in the words of Les Brown, I will see you at the top because the bottom is just too crowded.